The Alpha Horizon. Thinking different, acting aware.
Happy New Year and welcome to the first episode of 2022 of the Alpha Horizon podcast from Algebris Investments. There was clearly a lot going on in markets and at the macroeconomic level at the end of last year. And as we start 2022, the situation is unsurprisingly much the same. There were significant events in 2021, many of which had the capacity to unsettle risk assets. But this didn't happen widely, and any fallout was relatively contained. Risk assets generally were very strong last year, which makes for a fair amount of debate and discussion about their direction this year, particularly given extended valuations, inflation expectations, energy prices, and developments in China and emerging markets, to name but a few. In this episode of the Alpha Horizon, we will outline what we think are the main considerations for investors currently and try to explain and rationalise them. My name is Branson and I'm Head of Business Development. I'm very pleased to be joined once again by Alberto Gallo, Head of Global Credit Strategies at Algebris, to discuss these important topics. Hi Alberto, many thanks for joining me.
Thank you, Doug. Happy New Year and welcome back everyone to the Alpha Horizon.
So I'm going to start with a question about the pandemic. What are your thoughts on the outlook in terms of pandemic-related restrictions and how these will impact markets and risk assets?
Governments around the world had been extremely concerned about the Omicron variant last year when it started erupting in South Africa. And this prompted a lot of countries to increase restrictions and lockdowns again into the holidays. However, we are starting to have more evidence that the Omicron variant is essentially a less severe version of the virus. And over time, there are cases where viruses evolve in a less intense way and with a higher spread. This might mean that more people catch it. It might mean that we'll have to have more vaccinations and more boosters. But ultimately, it also means less severity, less hospitalizations, and a less strong reaction functions by governments later on. In other words, we think that Omicron has marked the beginning of the end for the pandemic. And in 2022, we might see, especially in the West, citizens coming back to their normal lives, going out, consuming goods, but also consuming services, travel, tourism, transport, energy. And so we've been particularly positive about reopening towards the end of last year. Perhaps we've been a bit early, but we think in 2022 we'll start seeing light at the end of the tunnel.
Understood. Thanks, Alberto. So one of the most important discussions currently is inflation. Can you please talk through your thoughts on the outlook for inflation? And the obvious related question is regarding interest rates. How many times do you think the Fed will raise rates this year?
We think the Federal Reserve will hike interest rates 4 times in 2022. The question is whether this will be enough to stop inflation. One former Fed governor, Frederick Mishkin, recently wrote in the Financial Times that the Fed has underestimated demand shocks while focusing too much on supply shocks and the bottlenecks imposed by the pandemic. We agree with this thesis, and we've been writing since the beginning of 2021 that inflation would be persistent and not transitory. In addition, with economic reopening, what we are seeing is that consumers are coming back to spending, and there's almost 6% of GDP accumulated in consumer savings. Now, when the US consumer goes back to a normal life, we might see something close to a revenge spending environment. Demand increases, prices go up in a constrained supply environment. On the supply side, many CEOs, from car makers to chip makers, are forecasting that bottlenecks will last for another 12 to 24 months. So this poses a question on the meaning of transitory. Is something that lasts 2-3 years, is it still transitory? And Fed governors and presidents are now convening on the idea that inflation is no longer transitory, it is persistent. The Federal Reserve PCE inflation projection stands at 2.6% for 2022 and then gradually goes down to 2.3 and 2.1 in 2023 and 24 respectively. Now, there are chances that these numbers might not decline as fast as the Fed is forecasting, and there's a chance that the Fed might have to increase the number of hikes that it has communicated to the market. Markets so far have priced in almost 4 hikes for 2022, but there's still a chance that the Fed might surprise. So we start the year with the realization that inflation is not transitory. Policymakers are finally acknowledging it. They're taking the foot off the accelerator, but they still haven't been pushing on the brakes.
Right, and as a follow-on to that, what about Europe and the ECB?
Inflation has always been a really rare animal in the eurozone. For the first time in many decades this year, the ECB is set to hit its target of 2%. Will inflation be transitory in the eurozone, or will it be persistent like in the US and the UK? We think this will depend on structural factors. Recently, ECB board member Isabel Schnabel talked about green investment and how this will drive inflation higher. Now, there are a number of structural factors, including green investment, that we think will drive inflation to be persistent in the eurozone as well. Green investment is a positive in the long run, and the eurozone needs it because of its dependency on foreign gas and energy imports. However, in the short term, it does mean that there's been less supply of energy from other sources, and so energy prices are higher. It means that Europe is forced currently to import gas from the US as Russia cuts its supply. But it also means that the same unit of energy will cost more. There's also other two drivers that are structural, which will mean higher prices. One is geopolitics. We're going into a world where geopolitical risk is higher, and many companies want to have more factories rather than outsourcing to China, to Taiwan, or to Vietnam, because transportation has turned to be less reliable, and because the number of natural disasters has also mean that production sometimes turns out to be less reliable. In the last year, we had around 250 global natural disasters, and this number was only 50 20 years ago. So having more factories, having domestic production as well as foreign production means that production costs might be higher. The third factor is domestic politics. Will employees ask for higher wages? And we already start seeing this in the US, where unemployment is already at a 3% handle. For the first time, not only employees in leisure, in hospitality, in very volatile sectors, but also employees in the manufacturing sectors are quitting. And the manufacturing sector is actually the one with the highest number of quits compared to pre-pandemic. This means that not only people are asking for higher wages, but they're also moving for better conditions. It is a good sign for workers, which unfortunately received stagnant wages for the last 20 years in the US, but it also means higher costs for companies. So there are a lot of structural signs why even in the eurozone, inflation might persist a little bit higher than the ECB target in the coming years, and perhaps the ECB will have to move from negative rates back to zero or above.
Great, so moving on, China had a tough year in 2021. What do you think is next for China and perhaps emerging markets more generally as well?
If the United States and the Eurozone are worrying about their economies overheating, the opposite is happening in China. Policymakers in China for a while have been worrying about financial stability and about deflating many of the asset bubbles that were developed over the last 15 years. As we know, China, starting from 2009, expanded its economy and transformed the largely rural production base into a more urban type of economy, catching up with the West. However, this also meant that there was rapid credit expansion and rapid development and a build-up of assets that were not always used in the property sector, and corresponding on the liability side of the balance sheet, a lot of debt. In the past years, Chinese government, at the local level, cracked down on property companies, and this meant that not only sales but also property prices started declining, resulting in a crunch across property developers. It is a transformational conflict, going from an economy that was based on production and urbanization and construction into a new economy that should be more based on services like in the West. This means that there are winners or losers, and the transformation so far is not painless. Xi Jinping's doctrine based on common prosperity has become more and more popular. It is almost a challenge to Western capitalism. To some extent, China wants to show that it's able to create a sustainable model based on services, but also a model where there's less monopolies, there's more competition, and there's less inequality. So far, investors are getting a stick and not a carrot, as many of the stocks and bonds in the Chinese market have declined sharply last year. And we would expect growth in China to be below 5% this year, unless governments and the PBOC start easing aggressively. This might not be the case, as the party remains a lot more focused on financial stability and long-term goals rather than the next quarter of growth. So what China is doing is painful in the short run, but potentially good in the long run. What this means for other emerging markets is headwinds. There are countries like Turkey, for example, Egypt, Pakistan, many commodity importers with relatively weak balance sheets that are already facing headwinds. We believe 2022 will be relatively tough for many countries in the emerging market space, as Chinese growth, which was the engine of many commodity exporters, starts slowing. And on the other hand, commodity importers will struggle because of the higher price of imports. So we're pretty cautious. We are playing defense in EM, and we're focusing on economies that are already strong with relatively high FX reserves and where central banks have been cautious, like Russia, for example, or Mexico.
And then moving on to my last question, which is perhaps a little unfair. What are you excited about in terms of risk assets for 2022?
After 2 years of record fiscal stimulus and record monetary stimulus, in 2022, finally markets will have to run without holding the hand of policymakers. This means that many asset classes that were propped up by very low interest rates might have to reprice. In November last year, we wrote that much of the magic that was holding asset prices up was the pixie dust of negative real interest rates. In other words, with interest rates 1% or 1.5% below the level of inflation, investors were almost forced to buy credit, to buy equities, and to buy also cash park assets without any cash flows, like crypto or property or art. When interest rates rise, things change. And today, if real rates go up from -1% to 0, in the US, we might see a lot of repricing. If we look at previous decades, for a 5 to 6% level of inflation, which is what we have in the US, the 10-year bond yield used to be in a range between 4% and 8%. It is now at 1.8%. If we think about stocks, again, for a 5%, 6% level of inflation, the CAPE multiple, which is currently at 40 times, used to be between 15 and 25 times. So an environment of very negative real rates, of everything flying up, of TINA, there's no alternative, has pushed both bond yields to be extremely low and asset prices to be extremely high. Now, the Federal Reserve has recently talked about using quantitative tightening in addition to interest rates, and increasingly using a reduction of, not only reduction of purchases, but also of their existing balance sheet to tighten monetary policy. According to sell-side estimates, the amount of balance sheet reduction over the coming 2 years, might be equivalent to 100 or 200 bips of hikes. What this means is that there will be headwinds for beta, there will be headwinds for asset prices, and particularly for expensive asset prices. Now, on the one hand, this is a more difficult environment, but on the other hand, it's also exciting because while in the past indices outperformed and assets that didn't really have a lot of value also outperformed just because investors had liquidity, in the future we might see more winners and losers, we might see more dispersion, and we might see, active investing finally taking the advantage. And we strongly believe that to invest in fixed income today, you need a very different approach to portfolio construction and a very different approach to alpha to what you were used to in the past.
So that leaves me to thank Alberto for his time, and as always, to thank our listeners.
Thanks, Doug, and thanks everyone for catching up with us in the Alpha Horizon, and good luck for 2022.
Those of you more familiar with Algebris will be aware of our regular commentary, The Silver Bullet. The next edition of this will cover and expand on these topics covered in this episode. So until next time.
The Alpha Horizon. Thinking different, acting aware.